The Super Bowl was played this past weekend. As most of you know, the Kansas City Chiefs, the AFC team, won the game. Well, it so happens that there's a belief that a win by an AFC team predicts a bear market for the rest of the year, and a win by the NFC team predicts a bull market by the end of the year. In this video, we explore whether this indicator has any validity statistically, and we share an option strategy that allows you to take advantage of indicators, whether they have a real edge or not. I'm Seth Freudberg, the head trader of S&P Capital's options trading desk, and we're one of the top proprietary trading firms in the world with numerous 7- and even 8-figure per year traders. You found the right place to learn. Hi, I'm Seth Freudberg, and I'm the head trader of S&P Capital's options trading desk. And while I didn't have a bias for any particular football team in the Super Bowl over the weekend, as you can see, let's just say that the Kansas City Chiefs' victory this past Sunday was not my preferred outcome. But be that as it may, you might know that over the years, there have been many articles written about a special market predictive tool known as the Super Bowl indicator. You see, the Super Bowl indicator states that when a team that was originally part of the old American Football League, regardless of which conference they're in now, wins the Super Bowl, it indicates that the market will be bearish for the rest of the year. And if a team was originally part of the old National Football League, if one of those teams wins the Super Bowl, the indicator signals a bullish market for the rest of the year. If you're an expansion team, which opened up since the two leagues merged, you're assigned to the NFL if you're an NFC team, and to the AFL if you're an AFC team. And that's how the Super Bowl indicator works, which means that because the Chiefs, unfortunately, won the Super Bowl, they're an original American Football League team, and so the indicator would predict that this year the market will be bearish. And so we decided to dig a little further to see, hey, does this Super Bowl indicator actually work? And can it be relied on as the basis of a trade? Well, as it turns out, originally back in the last century, the Super Bowl indicator actually had a 90% accuracy rate, even though it's based on an obviously nonsensical correlation between two totally unrelated things, football games and the stock market. However, if you go back to the last 10 years, you'll find that, in fact, the Super Bowl indicator has had absolutely zero predictive value. And in fact, as you can see from this detailed list of the last 10 years, it was only right 30% of the time, which has less predictive value, actually, than Punxsutawney Phil, the groundhog from Pennsylvania, who predicts how many weeks of winter are left. And so this should be a cautionary tale that not every indicator works, and then you need to do some back testing to see if it actually does before you jump in and risk your hard-earned money to capitalize on that indicator. But this also brings to mind a reality that happens to a lot of traders, which is that in many cases you may have a fairly reliable indicator. However, on any given day, it just may not be giving you a clear signal. And in fact, the indicator may be stuck somewhere in between so that you have neither a bullish or a bearish signal. So are you just stuck then and you can't trade that day? And the definitive and wonderful answer to that question is that you absolutely can trade on days where you're not getting a clear signal, because a certain option strategy allows you to make really good money on just such days where there's no clear direction indicated. And the strategy we're about to teach you is a really good example of this. In order to explain to you how the strategy works, we need to make sure that everyone watching the video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. And so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 4,075. So the call seller just pockets the premium. And so the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below that put strike price of 40.75. But the 4,000 puts, those would expire worthless because the market didn't close below the 4,000 strike price. Okay, so with that said, we methodically went through each of the last 10 years. And on the Monday after the Super Bowl, that next morning, first thing in the morning, we went ahead and did the following. We looked at where the market opened up that day, which on the day after the Super Bowl in 2013 was 15-14-30. And we went to an options chain which expired on the last day of the year. And we bought 4 calls and 4 puts at the same strike price near where the index was trading at that moment, which were the 1,500 calls and the 1,500 puts on that day, as you can see. And so when a trader buys calls and puts at the same strike price and the same expiration chain, options traders refer to that trade as a long straddle. And it's a perfect strategy for a situation where you're just not sure where the market is going. Now, let's understand what this means from a cash flow standpoint. And so, as you can see, first of all, we paid a price of $83.30 for each of the 4 1,500 call options. And remember, each options contract represents $100 for each point beyond the strike price. So you multiply that by 100, and we bought 4 of those. So you multiply that by 4, which results in a total cash cost of $33,320. And using a similar calculation, the 4 1,500 puts cost us $36.20 for a total cost of $69,344, 4 of these long straddles in 2013. Now, if we move to year end 2013, you can see the SPX index had climbed all the way up to 1849.44, way up from the 1514.30, which was the price the Monday after the Super Bowl that year. And so now we're in a position, because it's the end of the year and the options have expired, to value the options that we bought. And so let's do that first by looking at the value of the long calls. And as you can see, we arrive at the value of each of those options logically by subtracting the final price of the year, that 1849.44, from the strike price of 1,500, which leaves us with 349.44. And so we again multiply that by 100 and then by 4, signifying the number of lots we bought, for a total value of $139,776. Now turning to the puts, well, those expired worthless because they only pay off at a market close below their strike price of 1,500. So those went out at 0 value. And so subtracting the initial trade cost out, our profit was $70,436, which constitutes a 101% return on that capital in slightly under a year. Now, we obviously aren't going to win this trade this big every year, but we did this same sample trade, buying at the money calls and at the money puts the Monday after the Super Bowl for the entire 10-year period of 2013 to 2022. And here are the results we came up with. It turns out that if you picked no direction and just bought the long straddle, essentially making a bet on both directions right after the Super Bowl each year, you'd have made 18.6% return per year on average, winning in 8 of the 10 years. So what I'd like you to take away from today's video is that there are many times that a trader is faced with a situation where he has no idea whether to be bullish or bearish. Either his technical indicators are stuck in the middle between the 2 potential outcomes, or for some other reason, he just doesn't have any historical basis to think that there's edge in either direction. And the message is that there is a way to trade in those circumstances. And what we showed you today is an example of what are known as market neutral options trades, which are a bet on both directions, making the most sense. The professional traders know that they have these tools at their disposal, and so they're able to trade in many more circumstances than you'd think. So now you understand the versatility and power of options, but did you know that you can utilize options to make very short-term day trades to capitalize on these benefits more often? Check the video appearing on your screen right now to find out about an effective one-day option strategy.